Ready to make financing work for your clients? Welcome to Loan Logic with Maria Arellano and Myrna Crowther, part of the Ready.Set.REALTOR series, where stronger financing leads to stronger offers.
They haven't even managed to gather some pay stubs for your lender. I mean, that's not fair to you and really not fair to them or the sellers out there, listing agents, because you're just not prepared. So that is why loan readiness really does matter, not just because it'll help everything go smoother, but really, as professionals, that's how we want it to be. There's going to be fewer surprises during escrow. There's increased confidence. Everybody's going to be a lot more confident. And obviously, negotiating power is going to be improved. So pre-qualification versus pre-approval. Anybody have like a quick kind of bullet point on what you perceive that to be?
When you're talking about pre-approvals, so there's a difference between going and getting like a bank statement saying, yes, they're approved or they have cash funds available versus going to a lender and getting a pre-approval directly from a lender.
What was the first part about the bank?
Okay, so just small more background. My father and I are buying this house together. He's very old school and he thinks that he doesn't need a pre-approval, that he can just go to his bank and say, I have cash and here's proof of my cash funds, and that's enough. And it hasn't been enough, and it hasn't made it easy for us to basically negotiate on a home. And so how would you argue that with him? Like, you really do need a pre-approval from a lender, not just from your bank.
Yeah, and I mean, it's not really so much an argument, but really it's just, and that's what it is, just having those hard conversations. And you've got to, it's like any relationship really, right? You got to say, this is how it is. I mean, maybe it was a certain way before, handshake, that type of thing, but it really isn't anymore. You can't even go look at homes or actually yet go into a property until you have a pre-approval letter a lot of times. So he's just setting himself up by not receiving the information for really a hardship. I mean, it's going to be a struggle throughout then if that's the case, because you just really need to be very transparent. With even proof of funds, I mean, we redact a lot of that information, but you got these conversations where clients are comfortable getting that information to, not maybe necessary to you, but the lender, so that then that's how we are empowered to negotiate, be part of that negotiation on your behalf, because what we do as lenders, we have everything ready. You have to have everything ready in case there's a cross qual. The last thing you want to do is have your customer, which, your client is my client, miss out on a home because I was, I don't know, doing something else and not having that file ready to send to that cross-qual lender in case that ever does happen. So yeah, I mean, he's not ready to buy, unfortunately, until you can pry all that stuff, because he's gonna need to provide that information. So really the pre-qual versus the pre-approval is pre-qual. We have a conversation. Hey, how are you? Have you ever been married? These little simple things will forever make it easier on your transaction, because if you are married, that's going to dictate a lot. If you're widowed, maybe the spouse, the deceased spouse was a veteran, so you need all of these little conversations that we're having them because they're very impactful. So the pre-qual is just to find out, like, hey, where are you? Oh, you're ready to buy now. Now provide pay stubs, W-2s, then we can get you pre-approved. Okay, so that's really the difference. A pre-qual is like a conversation, a good conversation where you what do? You uncover, different things, red flags, things that aren't red flags. The pre-approval is just what it says. You've collected their documentation, you pried it from their hands, and if we're in the industry long enough, they're approved, or we actually send it to an underwriter as well. Okay. Let's go on to the next subject. Documents, or does anybody have? I guess we're going to do questions at the end. So maybe jot down if you have a question. Because as much as I want conversation, I want to cover everything, and then you guys tell me what's important by your questions that you ask. Documents buyers should gather. Basics, right? First of all, IDs. IDs are imperative. I will not run a credit report until I see somebody's ID. And I don't let my borrowers order their own online and apply online. I'm really old school. I've been doing this for 33 years. So I don't want them misspelling their name, not having the Social Security number right, because that is going to be really bad from the start. So IDs is not on here, but definitely, or it is actually on here. That you need a spelling. You need, if it's hyphenated, not hyphenated, you can't add names. You can take out names if they don't want the Smith or whatever to their Jones name or whatever, but all very important. Pay stubs, W-2s, bank statements. And it's always good to ask for more documentation upfront. So if my borrowers are not self-employed, I will always try to at least collect 1 year's tax returns, because I'm nosy and I want to see what else they've been doing on their taxes, so that if it doesn't come up later, do they have a Schedule C business, because everybody has a side hustle that may be helpful to me, that may be detrimental to me in the future. So I want to know. And I just put it in my back pocket. I'm not going to tell anybody, but I already have my plan B in case it comes, is something that comes up later. I want to know. The more I know, the better. And then I can just, know how to proceed. So these document items here. I would not, and I've never been a realtor, take anybody, unless they're a previous customer or their family, looking at homes without them having turned this in to the lender that you recommend that they visit, right? That's pretty standard. Does anybody sometimes not do that? Because you don't want to seem like, oh, you're overbearing, but you have to do that. I mean, if you want to, especially gas is so expensive these days, you just don't want to take anybody. No? Okay. Understanding credit scores. Anybody? This is a really good topic. Credit scores are very important. The higher the FICO score, typically, the better the interest rate. Scores dictate what product one of your clients might be eligible for, which ones they are not. However, if they don't have a FICO score, that is okay. We will still lend. I mean, there's all sorts of options. If bad credit, they're still lendable. So, and I was just talking to somebody out in the back. I mean, I've been in business for a very long time, but I got my start in mortgage banking. So when you are with one outfit, you only really can originate and approve somebody based on the philosophy of that company. So it's what they think, if somebody, has a certain philosophy or appetite for risk, then you're limited to that. But there are other options always available. It's not just, we never take no for an answer, right? So we always get a no and then we figure out another way. So that's how it is in lending. There's always a way. So you have to be an advocate for your client. So you always have to, while you're attending these, you have to see what's out there, what's new in lending. You're not lenders, but you want enough information so that you can disseminate and know at least how to guide. This is what we do for our clients, right? We advocate on their behalf. If I don't know something and, estate planning, we know people to send them, so that's really our job, is to do what we can so that they successfully can become homeowners and not just accept the first no. So credit score is very important, but if there's an issue, there is a way around it. Well, VA is very flexible, by the way. VA really does not have very many what we call overlays in lending. Overlays is just roadblocks that certain companies have on what they're going to lend and not. But you can go down in the 500s. You could have no FICO score. So there really isn't, everybody is different. Every situation is different. Every client is different. Their explanations of what happened, why their scores aren't where they need to be are different. So we just need to explain it. And worst case, they just cannot get a loan right now and you're going to give them the guidance, we will, on what they need to do. You need to do this, we give them a game plan. Whether they follow it, that's up to them. Okay. But does everybody know what an overlay is? Has anybody heard that or have an idea or want to guess? Overlay? No?
Probably a bunch of things that we will put together, like pay on time,
Yeah, yeah.
just putting it all together.
Yeah, I guess so. It's a philosophy. It's a way of doing things. Yeah. But have you ever so you go into a store and you see the business has like a sign that says, we reserve the right to refuse service for whatever, So it's kind of like that. There's like maybe company A, and this is actually a fact. There's a bank, actually a few banks that if one of your clients goes to the bank, I really love Wells Fargo, I really love B of A or whatever the bank may be. And I really want to get my home loan with them. I have everything with them. That's great. And then they fall in love with this manufactured home. It's like built in 2025 and it's amazing. It's got land and it can add an ADU in the back. And whatever company we don't lend on manufactured homes, So that's an overlay. They have just decided they don't want to do that. Or your credit score isn't 620. We don't want to lend on that. So it's things that they've just put on there because they legitimately reserve the right to be more conservative than FHA. If FHA allows it, doesn't mean they're going to allow it. So that's an overlay where you can go to another place and think, oh yeah, we lend on manufactured homes all day. So that's the thing. So don't, again, accept no for an answer for your clients when they come and talk to you and they're like, oh my gosh, I really wanted this, but they're not lending on it. No, there's other people that will lend, just kind of get them to look at everything very macro. Okay. So, and that's an overlay. Some companies require, like I said, that FICO score, or if you're self-employed, you have to be self-employed for 2 years, you hear that, but there's a lot of companies that will lend for just 1 year. So what you think is there is typically probably not that. Okay. All right. So that's credit scores. Credit scores, what do we learn? They're all good. But, if you have bad, yeah, I mean, they really are. They're fine. It's an educational thing. We give them guidance and maybe they will buy now with a little bit higher rate and then they can always refinance when they fix it, but at least they're in the house now and they can improve their situation later. So you got to always think about the reasons why they should buy now than waiting to improve their score to this artificial number that they think they need when later the rates are going to be higher and then so are the sales prices. So like they're really, what did you gain, Okay, next question. Next is debt to income ratio. All right. Debt to income ratio, basically it's in the beginning of the business, it used to be there were like 20, and then Myrna, you can jump in anytime you want. Myrna is the other lender tonight. 28, 36, you used to hear that a lot. we, as lenders, we will come up with a gross amount that your client or you guys, if you're in the market, make. You make X amount. No more than X amount of that, then 26% of whatever your gross income is can go toward your payments of your house. And then the back end ratio, no more than that percentage can go to your payments of your new house, which that includes principal and interest, taxes and insurance and HOA dues if that applies, solar if that's there, plus any bills that you have, cars, credit cards, student loans. So then those are the ratios there. That used to be 28, 36. Then it was like 33, 38. So 33% of your gross income can go towards house, 38 with your house plus all your other bills. But now it's all over the place because there's manual underwriting. VA can go over 60%, and that might not be outside the realm. I mean, because people, and it's not, when I talk to my old friends at the bank, they're like, well, you're setting them up for failure. No, if people want to own a house, they will rebudget everything, they're not going to be spending superfluously because they want that house. I mean, why wouldn't you? So people do change their thought process, the way of how they budget and spend their money. And so if they're willing to do that, we can go up much higher on the debt to income ratio, right, Myrna? Yeah.
What is it?
It's like 56 on FHA and then VAs all over the place. So don't let that also deter. And then just as a quick little note, there's, and Myrna has a handout too, this is a list too of like, you'll find non-conforming type products, what they call non-QM, creative financing. This is by no means a comprehensive list, but there's programs out there that will, if the debt to income ratio is a problem, they're, because let's say, somebody's got a side hustle and they just don't report it, or they've got a family living there, and they're not qualifying because they have bad credit, but they're sticking together and they're going to, cohabitate. There are other types of loans. There are actually a no doc loan. So you don't have any ratios. How do you like that? You have to put 20% down and the rate's a little higher. And then when somebody's maybe starts declaring their income, they can refinance out of that to a regular loan, whatever the situation was. There are 1099 only loans. They're just P&L only loans. Some of them that you self-prepare, some that a CPA has to, some that less than a CPA, like a CTEC can do. So if a debt to income ratio is an issue, there's a way to solve that. Okay. So just always, again, keep your mind open so that you assist your clients. Down payment options. That's the next grid. Okay. Down payment, your standard FHA, 3.5% down. Conventional, 3% down, VA 0, USDA 0. And of course, with these down payment requirements, here you don't see any 20% down because you don't need that. I know a lot of the public still thinks you need 20% down to buy. So again, you got to make them aware that you do not. FHA, you can combine that with down payment assistance. There's down payment assistance programs out there for first-time home buyers. Some like the Dream for All. I've got a family in San Jose. One of them had to be a first-generation buyer. But mainly the definition of a first-time home buyer is you couldn't have owned a home in the last 3 years. But there are other down payment assistance programs that you can even have rental properties. So don't let that deter you. You can have an FHA loan now on a house and you're going to move to LA because of work or whatever. You can get another FHA loan at 3.5% down because there's a commute. So there's different caveats on why you can have different things. There's like the world is your oyster, and therefore by extension to your clients. Okay. Conventional 3% down, again, down payment assistance, that could go to 0. USDA and VA is pretty obvious. Okay. Well, we'll save the questions till the end. Down payment assistance, I kind of just mentioned that. Some are forgivable, some are not. But they're so varied and they're as varied as your clients are. So again, what's going to determine the down payment assistance availability, if there is, it's your customer, it's their FICO score, it's their first-time home buyer, it's geography, because different counties, different cities have different programs. It's their income. Some of them are income restriction based off the household, so just one income, some based on how many in your family, all sorts, okay? So your customer determines a lot of that, and that conversation, that pre-qual, when we're just having, that's where we, like super nosy. That's where everything, like we're a stranger, but I know everything about them, probably more than their family by the time we're done. And it's a very easy, smooth conversation, but we go just right down to it. Are you married? Have you ever been married? Because then that impacts it, right? If you're single or unmarried, widowed, and so all of their ability to qualify will depend on their situation and where they're buying to. Common financing challenges. These are really good to just really chat with your clients about as well. New debt to avoid. Don't buy anything unless you talk to your loan officer, because sometimes, if a car or something happens and they need a car for work, I mean, what are you going to do? So then we have to figure out, okay, can we still do this? What do we need? Maybe we could pay off this little thing. Maybe we can buy down the rate a little. Maybe we're still good, but we have to have that conversation because we don't want to know about it, afterwards. So anything, just encourage them to be very open and transparent, because as a loan officer, I'm not looking for ways to not help them buy a house. I'm looking for ways to buy a house. What can we do? There's always gray area. Job changes, typically, change a job, that's fine, but we just need to know about it. Are you going to get paid the same rate? Are you in the same line of work? It all depends. If it's not going to look good, again, they just encourage them to talk to us. Then just please hold on another 3 weeks, then quit, let's just get you your keys and then you can change jobs. But sometimes it's fine, it's doable. Large unexplained deposits. So if they're starting to sell items or getting gift, we have those conversations with them as well, but it's good for them to hear from you as well. Don't do anything. Don't, make any sudden, don't miss payments for sure on anything, keep paying on time, just do everything you're doing, but just check with us first. And some really go way above board. I had this sweet young couple like, hey, we're going to go out to eat. Can I put that on a credit card? Yes, you can charge dinner, that's fine. Just not the big stuff. Okay. Does anybody have any horror stories about that? Yeah. What happened? We've had that, and we've had them finally, very quickly find another job and re-verify it. Yeah. Again, some lenders will you got to have a full pay stat, no. So it just depends. Then you have to switch products and whatever, but yeah, same line of work, but yeah. To be able to gain employment when you lose it is better than always being in one job and then not being able to get another. The whole thing is you're gainfully employed, unless, so we can make it work. We can explain things. Yeah. Okay. So how can realtors help? Help us. Help us help you. Help us help you. Okay. Connect buyers with lenders early for sure, right? You guys don't go out with them unless they're past clients or a family of past clients without them talking to somebody about a loan. Yeah. Who's going to do that still? Is everybody going to take heed? Okay, good. Right. Organize their documents. Yes, everybody, we all should. Lenders, yeah. I just got a call. Well, I got an email from TC. Hey, can you give me proof of funds? I'm like, okay, but that's a low priority. Then you're scrounging, you're trying to backtrack and trying to, get everything you need. So just do it up front and encourage them to do that. So just continue to have these conversations. I think just like and don't get me started on a relationship, any relationship, just be upfront, just be kind, just be, proactive, just tell them why, maybe tell them a story or two, but not a lot, but just let them know where everybody's here to help. We want them to get their key. So set realistic expectations. I think sometimes, and it hasn't happened very often, and Myrna might, be able to tell me too, sometimes you get there's people that are hard to deal with, right? The lenders, your neighbors, me. But if you have that, I don't know, that aura, that philosophy, that way of interacting with your clients where, the lender's here to, they're going to feed on that, and then they're not going to provide the documents that we need. Then it's going to be contentious. Nobody's going to benefit. It's like when you're raising your kids, tell them to be nice, tell them to do their homework, tell them to have good, we need that. And if you guys can tell them, listen, the lender is here to really be to help. And I was in a class with that appraiser, the appraiser Brad. He says, we're the government, we're here to help. But really, we're the lender, we're here to help. We don't, for the most part, we're all commissioned, just like you guys, self-employed. We don't get paid until, the deal funds. So we're here to help, So if you have that relationship with your clients, when you encourage them to have that relationship with the people around them that are going to help them get to the finish line, then I think everybody's really going to benefit. And it's going to be a really good transaction. You're going to get referrals, that's what we want, right? And yeah, communication is key. All of us need to communicate, and that's what we all try to do at every step. We got you pre-approved. Everybody knows we got you. The appraisal came in. Everybody knows we got the pre-approval. At every stage, everybody gets that email, that communication. And I know you're a weekend warrior, probably. I'm always available, text. So you need to find somebody that's going to do that. That's going to help you win, first of all, that deal with the cross quals. I'm ready to send it to somebody. We help people cross-qual other people and say, these guys haven't even gotten me anything. This offer, the loan officer on top of it. If it was me, I'd do that, So we're here to help in really any way we can. It's not just, one dimensional. Okay. And the last thing is communicate early, weekly. Oh yeah. And respond quickly, solve issues proactively. And one of the ways you solve issues proactively is you really dig deep, and then you find out what can be a problem so that you solve it before it becomes a problem. Because and that's why I like to look at those tax returns. That's why I look at my pay stubs, because I want to see what's being deducted. Oh, look, there's a garnishment. I know about it right now because I saw it with my eyes. Then waiting 2-3 weeks down when you're in escrow, oh, I have a garnishment, and that might come up later. So just look at, that's what we do. We gotta look at the paperwork. We gotta do the math. We gotta do all of that. So, yeah. Any questions? How did I do with time? Good. Okay, questions? Or should we save them to the very end? Very end. Okay. Take it away. Thank you, guys.
Thank you, Maria. Yeah, give her a round of applause.
Is somebody doing for me?
Thank you, Maria. So now I'd like to introduce our second instructor for today, Myrna Crowther. Myrna's passion for lending started as a branch manager for Bank of America Home Loan Center in Marietta for 6 years, and then as a senior loan officer for Washington Mutual, Chase, Home Saving of America, and now the direct lending bank of the National PrimeLending for 15 of those years with the ability to broker out if necessary. She is bilingual and works in all states offering home loans such as construction, renovation, investment, relocation, purchase, and refinance home loans. Specializing in first-time homebuyer programs allows her to provide opportunities to fulfill the homeownership dreams. She is invested in her community as a past chair director of the Southwest Boys and Girls Club, as well as a member of the Toastmasters, Professional Women's Roundtable, and SRCAR committees. A little fun fact about Myrna, she has been in the mortgage business for 35 years, and she enjoys pickleball, camping, and gardening to re-energize. Now let's put together our hands for Myrna.
Well, welcome, guests. I'm so glad that we have you guys here because education is key. And Maria, you did a great job. So thank you. It's really nice to have, different perspectives of the lending arena, especially with, over 30 years for both of us. So I'm going to go ahead and start with some of the questions that we were asked to go over. And one of them is how financing impacts offer on competitiveness. So when you receive an offer, you look at the type of loan to see if they're getting an FHA or AVA or a conventional loan. And a lot of times the government loans are going to be more restrictive. They're going to require more repairs on the appraisal. So the competitiveness on that would be if it's conventional, you don't even have to get a termite report. It's not required. So there are little things like that that you want to be aware of, because if you have two offers like that, the buyers are really need to know that information. The other thing too is, for example, and I'm taking Toastmasters for the reason. So if you hear me say so, or I'm trying to stop doing that. The other question that we have is regarding, I think it's the next one. I went over all that. So yeah, there we go. As Maria had mentioned, VA, FHA, USDA, VA is by far the best loan out there. I have to just tell you, the rates are lower. There's no mortgage insurance. And the borrowers qualify with a much higher debt to income ratio. Why? Because they pay their mortgage. They are one of the best customers on making payments for their home overall. So the lenders really acknowledge that, and the investors, Freddie Mac, Fannie Mae. So that would be great. The other thing too is conventional loans, like Maria mentioned, some of the stuff is duplicated, but just to kind of give you an idea of the programs, and there should be a cheat sheet that has the different programs that we provided. That gives you an idea what programs are out there that you may not be aware of, ITIN loans, government loans, construction loans, things like that. Manufacturer as well. And the conventional loans are 3%, and then 5% if they are no longer a first-time home buyer. So what is a first-time home buyer? Does anybody can give me an idea what you think a first-time home buyer is? 3. So yeah, 3 years. But there were like VA, you can buy another home if it's FHA too. If it's 100 miles away, you could buy another one. You just have to explain it. The only one that's really strict is Cal FHA. You cannot own a home in 3 years. So no, you can't be on title, can't have a loan. So Cal FHA is because of the grant or the down payment assistance, very strict on that. But some of the other ones you can't. And if you're a repeat customer on a conventional, it's 5%. No longer can you put 3% down. Yeah, because we're going to go with the investor, which is Freddie Mac, Fannie Mae. That's who we end up selling the loans to. So we all abide by the same investor. And the Cal FHA loans, just to kind of give you an idea, I know you asked about FICO scores. With a regular FHA loan, typically 540 credit score is the minimum to get a decent rate. There are manual loans that you could do on something like that. Conventional loans are about 640 credit score. With Cal FHA, again, very strict. They have to have no lower than a 640 credit score for an FHA loan. 45% is the maximum debt ratio, cannot be 45.01. Very strict on that. If it's a conventional loan, then 660 would be the FICO score. And again, 45% debt to income ratio for the Cal FHA, which offers the down payment assistance of 3.5%. A silent second is what it is. If they have a credit score of 700, then they can actually have 50% debt to income ratio. So I had a loan today. And what we do, I don't know if you do this too, but we do a lot of pre-qualifications. And you hate to run people's credit. So we do a soft pull. What that means is either one bureau or two bureaus. And it doesn't hit as a hard inquiry. So I had a loan today, and the credit score, Cal FHA, the credit score was 694 and 705 was the second score. When you have two bureaus, you have to go with the lower. So therefore, it would be a 45% debt to income ratio. So I thought, well, it was like 350,000 for a house. You can't really find that kind of house. And so I ran the bureau with 3 to see what the third credit score was going to be. And it came back at 710. So now they were over 700. I was able to increase the loan amount, get them a higher pre-approval letter. And that's because of the bureaus. If it's 3 bureaus, you take the middle score. If it's 2 bureaus, you take the lower of the 2. That's how it goes. And it's a hard pool, but it was worth it. And then the other thing we have is finding the best loan program. So matching, this is really critical. I know that we do a lot of interviewing with customers. Over the years, the customers feel comfortable talking to you and giving you the personal information. And the more you talk to the client, you start to figure out, okay, do they have credit issues? Do they have down payment issues? Do they have ability to get gift? Do they have family members that have gift? Because you can start formulating and narrowing down what kind of loan they could qualify for, and then give them several options and go, okay, you know what, you qualify for these 2. Here are the rates based on your credit score. Unless you want us to help you do a rapid rescore and increase, if you have time, we can go ahead and fix your credit report and increase it. And then we have tools that we can tell the customer, hey, if you pay down this debt to 30%, your credit score is going to go up by 10% or 10 points or 5 points if they have time. And a lot of it is how quickly are they really looking to buy a house. So the sooner that we get our hands with the customer, the better it is for us to try to help them get the right loan, and obviously a higher loan. And then the other thing too is like I said, if it's military, first question I ask, were you in the military? Have you served at least 90 days? Because 90 days you'd be eligible for a VA. So all you need is a certificate of eligibility and they could buy a home. And that's the best loan, lowest interest rate. Again, no down payment and no mortgage insurance as well too. That's the beauty of that loan. The other thing too is credit profile. Okay, available funds to close. And then, a lot of times it's, do they not have the money? Then you go, do you have a family member that can give you money? Or someone that you know? If not, then you tap into the down payment assistance programs. And most of them, they're not free money. It's just a second that sits on top of the property as a second deed of trust. And usually it's a 1% interest rate, like in CalFHA, and they don't have to make payments on that. They still get accrued interest, but they don't have to make a payment on that house or on that second unless they sell the house or refinance the house. Well, VA would be 20% down, 20% down. Yeah. And there are, you can have the 5, 15%. You can actually even do 2 loans to avoid mortgage insurance. You could do like an 80 first and a 80 first, and then you can do a 10% second, and then they put 10% down. So you're doing like an equity loan, so you avoid the mortgage insurance. So you could structure it that way. Yeah. So there's ways that you can do that. You can even do where you pay the insurance up front. Say the seller is giving you money. You can actually do a lump sum mortgage insurance, and therefore the payment doesn't have a monthly insurance payment. So we could do that too with the insurance companies. So we can structure it that way. All right. So contract to closing. This one here is really important. So typically the underwriting review, and a lot of this is communication is key to closing. I like to go ahead and communicate with everybody up front. So when I go ahead and talk to the agent, I want the executed contract, so I know there's no changes and the addendum is included, because the addendum is so important. You miss out on a lot if you don't have that page, that addendum page. The other thing too is it going to be a 10-day contingency or is it going to be 15-day contingency? Because that affects me. I'm the one that has to perform. I have to get that appraisal ordered ASAP. I have to get that loan approved immediately. So I have one right now that they did a 7-day contingency. Wow. I'm like, okay, let me take that loan. I had her pre-qualified. And so I had part of it, but once I got the contract, then does it have an HOA? Because I need the HOA documentation. No, thank God. And then it was, okay, I got to get it to the underwriter. So the underwriter can eagle eye it and make sure that I didn't miss anything, because these underwriters have such amazing eagle eyes. So I said, okay, I'm going to send it to the underwriter. In the meantime, I'm going to go forward and get that appraisal ordered. I got lucky because when I ran it through our system, it said I didn't need a full appraisal. So sometimes we get an appraisal waiver. This one was a PDR, which was property data. I don't know if you're familiar with this, property data assessment. So the appraisal fee was only $250 and it took 3 days. They go out there. It's not an appraiser that goes out there. It's a trained data collector. He goes out to the property, takes pictures, and does an assessment. And Freddie Mac, Fannie Mae accept that. And they're the ones that as you run DU, it says you could go with this. We'll accept it. And I'm like, yeah, 3 days, I'll do that, you know? So, and it also saved the customer 200, you know, a lot of money because it was $950 that I put for the appraisal and they only got to pay $250. So it saved them a little money, and we got the approval done in 5 days with the appraisal. So I look good. Borrower was like, okay, what else? Insurance. Get the insurance. We have a quote. Let's get the policy. You can close early if you want. So that was really nice. So again, those are the things I think are important. Like, you know, like Maria said, is looking at the file. Is the credit report, when you pull a credit report, you're qualifying them. And then all of a sudden, you know, the credit report only has 30 days before it expires. And then you get a contract. Do you order a new credit report or do you try to close it in 30 days? If it's a 30-day escrow, what do you think? Anybody? Seller may not want to close early. So what happens if the notary is delayed and you're off by 1 day or 2 days? You got to order a new credit report. You may have a different credit score. You may have a new debt. So I don't. I usually just say, hey, I'm just going to order a new credit report. I don't want to run the risk that something happens and something pops up. And what happens is a lot of times behind the scenes, I don't know how that happens, but we've had funding, you know, where you're about to fund, and then all of a sudden a little flag pops up that the underwriter went to Home Depot and purchased a washing machine. It's not on the credit report yet, but it's going to be. And that gets flagged. And the funder says, hey, I got a flag from the bureaus. Now we got to investigate. Ask the customer if he bought anything. If he did, we need a receipt, a bill of what the payment's going to be. Then we have to incorporate it. So that's why I tell people, like Maria said, don't, you know, I usually give them one of the things not to do when they're buying a house. Very important. When they think it's not going to be shown, it's going to come out. So anyhow, I would order the credit report just to avoid my credit score changing. You know, 15 days is okay. I don't mind 15 days. It gives me time to make sure that we have the customer sign the loan documents, and then the documents go back, and then it funds, and then it records. You lose time, like 3 or 4 days for that. So I usually say 15 days, I'm okay with that. I can do that. I had a horror story. I had a purchase, and it was just the husband. And I said, you don't want your wife? No, she's fine. You know, we don't have to have her. I said, okay, but she'll have to sign a deed of trust in escrow because you're married. Oh yeah, no problem. And so she forgot. And then all of a sudden I said, okay, we're going to get documents ordered. Did your wife communicate with escrow? Oh, I don't think so, but she left. I go, where'd she go? Brazil. She went to go do some philanthropic work for 30 days and it was supposed to close in a week. And so I said, oh my gosh, what are we going to do? You know, and so I've got everybody involved, title, my regional manager. I'm like, okay, what can we do? She can't go to the, you know, the consulate's too far. You know, she's out doing some philanthropic work. And lo and behold, we found out that there is a Zoom notary that they can do. Yeah. So we did a Zoom notary. The notary public here saw her sign the document. She FedExed the document back, and then escrow was able to, lawyer's title was able to record it. And I thought, well, that's new. Good to know. But my bad, then I didn't follow through. I should have said, hey, escrow, did you get a call? Because, you know, all those little cracks that you find, they come up. And so I should have just said, did you get done on my checklist? Which, you know, I should have, but I didn't. Now I know. All right, next one. Okay, appraisal contingencies, we talked about that. And common financing issues, delays. Again, you have customers that will piecemeal, and that is the worst when they piecemeal. You ask them, like Maria said, you ask them for the W-2s, the pay stubs, the bank statements, not one statement, 2-month statements. That's what the underwriters will want, 2 months. Not just the first page of the statement. I know when you're trying to verify funds, you only need the first page to source it, you know, your down payment or your, what they're going to put down, but we need all the pages because they might have a loan on the bank statement that they didn't tell us about, or there's maybe student loans that are coming out that they didn't, you know, maybe it's not showing up on the credit report. The underwriter is going to ask for all pages, including the back page that doesn't say anything. And so I tell people, get me complete bank statements, all the pages, one through the end. You know, sometimes I get it, sometimes I don't, but I follow through and I tell them I need that. Same thing with pay stubs. If I pre-qualified them and it's been a while, I'll get 2 more bank statement or 2 more pay stubs because maybe they went on maternity leave. Unfortunately, they don't work. I shouldn't say unfortunately. They don't work during maternity leave, but we have to average their income if they're hourly. So that really lowers their income. And so we have to look at that as well. All right. Maria mentioned large deposits, gift funds. Sometimes you look and see, is there a large deposit? Where did it come from? You got a gift. We need to see a statement from the donor because we need to show who it came from. Employment verification, usually I'll do a VOD or VOE. And we have a lot of automated, so we have the work number, so we can actually verify their employment. All we just get is an authorization, and we get it. Nowadays, there's so much information with AI. And one of the things that we do is also, and I think Maria does too, is everything is now automatic. So when the appraiser is ordered, when the appraisal report is ordered, the customer gets notified, the agent gets notified before I even have time to email everybody. So it's nice that everything is automated. The loan has been approved, they get an announcement. It's an email that they get. So it's nice because, and I can turn that off, but I have mine on so that at least they get notified and all the agents get notified. Hey, loan's been approved, appraisal came in. Doesn't give the details like what it came in at, but it tells them that the appraisal report is in. So the file is moving. And if for some reason I'm out for one day, they get notified. Any questions so far? I know I'm kind of going fast here. I think that was it. Communication is key. So we just make sure that we communicate with the TCs and I have an assistant that also works with me, so I include her. Oh, so one of the things I tell the listing agent is when the appraiser is going to go out there, make sure the water heater is strapped, make sure there's a smoke detector, carbon monoxide detector. The appraiser will look for those. And if they're not there, they're going to go back out to inspect the house, charge the customer $150 to make sure that those things are in. Broken windows, hole in the carpet. So you try to get those things repaired, especially if it's FHA. All loans in California, they have to have the smoke detector and the carbon monoxide detector and the water heater. Those are mandatory. So you just want to make sure, and I usually tell them, make sure it's done because it's going to come back and it's going to hurt the buyer $150. So that's on the appraisal. Home inspectors, like the ones that you order for the customer before the appraisal goes out there, those are optional. So I know that the buyer pays for that separately. And then they do a different job than the appraiser. Because the appraiser is doing the appraisal for the lender for the investment part. Yeah, so the appraiser will say, hey, this is the contingency to satisfy the appraisal. It'll be on the report. And then the underwriter will say, you got to, they'll review it and they might challenge it and say, no, we don't need that. But they will go ahead and say, these things need to be cleared before we can continue with the appraisal clearance. Is there a different name by it? I know there was something in September. Do you know, Maria? We haven't gotten any formal email about that, but I heard something about September, so we may get it. Maybe they're still changing it to implement across the board. And now, as you see, they're doing the PDR where they're not even using an appraiser. They're having a data person just go out and take pictures and send my appraisal. Anyhow, so I think I'm going to close, but I wanted to at least let you know there's a realtor cheat sheet I hope you got. And it has a lot of information about mortgage basics and requirements that it's easy to see for a realtor. And I think that's it for me. So thank you very much. I appreciate the time.
Does anyone else have any questions from Maria and Myrna today? Because this is the end of the class. So if you guys have any questions, now's the time. Vic looks like he has a few questions.
Good time to leave.
No, Alma told me I have to keep you here till 7.
So everyone's pretty clear. No questions for them. All right. Well, thank you guys all for coming today. We hope you guys will come to the next one. And tomorrow, we have our legal update tomorrow. So if you haven't registered, there's still time.